Today, decoding market uncertainty. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and property news with a distinctively Australian flavour. Well, Wall Street's main indices fell again on Thursday, and a rally in US stocks faded late in the session as investors debated whether equities were becoming bargains after a sell-off to start the year that had seen the NASDAQ fall into correction territory. Major US indices had been up sharply, in fact, for most of the day after a steep drop to start the week. The NASDAQ on Wednesday closed down 10.7% below its November all-time high, confirming that it was in a correction situation. There seems to be a whole lack of conviction, said Randy Frederick, Vice President of Trading and Derivatives for Charles Schwab. The dip buyers step in, but then they run out of momentum. Stocks have gotten off to a rocky start in 2022 as a fast rise in Treasury yields amid concerns the Federal Reserve will become aggressive in controlling inflation has particularly hit tech and growth shares. Treasury yields were relatively steady on Thursday after dropping from two-year highs on Wednesday. Just the fact that they have not gone any higher, at least for the day, it's a welcome reprieve from the steady march higher that we have experienced, said David Joy, Chief Market Strategist at Emprise Financial. The S&P 500 ended sharply lower, paced by a slump in consumer discretionary stocks and fresh weakness in tech after the sector failed to hold onto intraday gains for the second day in a row. The S&P 500 fell 1.1%, the Dow Jones Industrial Average fell 0.9%, and the NASDAQ slipped 1.3%. Now, one interesting observation is that the NASDAQ has now hit its 200-day moving average. And interestingly, over the last 6 years, there have only been 4 episodes of sustained dips below that line. In all cases, the bold move below that line was characterized by an acceleration in sell-off. However, it's also important to note that the initial touch of the level was followed by a rather impressive upward jump. The tech analysis indicates that a pullback from the 200-day average usually determines the trend for the following days. And if we fall below that line by about 1%, we risk seeing an acceleration of the sell-off in the stock. The opposite is also true. Strong buying from this level promises to be the starting point for a strong recovery. Now, consumer discretionary stocks were led lower by Amazon.com and Garmin as sentiment turned negative on risk assets late in the session. And financials struggled to hold onto gains, even as investors digested better than expected quarterly results from the sector, and some bought the recent dip in bank stocks. The Travelers Company jumped more than 3% after the insurance company delivered blowout quarterly results that beat on the top and bottom lines, led by gains in premiums written. State Street and Bank of New York Mellon, both of which were under pressure a day earlier, following quarterly earnings that fell short of Wall Street forecasts, gained more than 1%. And M&T Bank and regional financials, however, were in the red after quarterly results missed analyst expectations. In tech, investors continued to sell into the strength as the sector paired gains to end the day in negative territory ahead of the start of quarterly results, with Netflix reporting after the closing bell. In fact, they reported 8.3 million net new paid subscribers in the fourth quarter, trailing its own forecast for 8.5 million, but roughly hitting the average analyst forecast, which was 8.3 million, and giving the streaming video service 221.8 million subscribers overall at the end of 2021. The number allayed the stark warnings from some analysts, including JP Morgan's Doug Amos, who had feared a significant shortfall of new subscribers. But executives do see another stark slowdown ahead. They predicted just 2.5 million net new subscribers in the first quarter, less than half the 5.8 million that analysts were projecting. Netflix executives said that the lack of new original programming, especially early in the quarter, was a factor in their forecast. Our guidance reflects a more back-end weighted content slate in the first quarter of 2022. For example, Bridgerton Series 2 and our new original film, The Adam Project, will both be launching in March, they wrote in a letter to shareholders following the announcement. In addition, while retention and engagement remained healthy, acquisition growth has not yet re-accelerated to pre-COVID levels. We think this may be due to several factors, including the ongoing COVID overhang and macroeconomic hardships in several parts of the world, they said. Netflix subscriber growth has waned as the COVID-19 pandemic has marched on, and the streaming service added 18.2 million new subscribers in 2021, fewer than it added in the first 6 months of 2020, when the virus first spread across the globe and caused a wave of shelter-in-place restrictions. As subscriber growth has slowed, Netflix has looked to increase prices in mature markets to continue to grow revenue. After hiking prices in October 2020 for the US and Canada, Netflix confirmed last week it was doing so again in that region, pushing the price of its basic plan higher than the costs of AT&T's HBO Max streaming service. Netflix said its sales grew to $7.71 billion in the holiday quarter, up from $6.6 billion in the same period a year ago. And profit was expected to decline as a wave of premieres required Netflix to recognize the costs of expensive content, such as the newest season of The Witcher. But the company reported earnings of $607 billion, or $1.33 a share, up from $1.19 a share a year ago. Analysts had expected earnings of 83 cents a share on sales of $7.71 billion. Netflix shares were down nearly 20% in after-hours trading following the announcement on Thursday, and the stock is down 12% over the past 12 months, while the S&P 500 broader index has improved 70% in the past year. Netflix continues to command viewer loyalty worldwide. 70% of its desktop visitors watch it exclusively, despite a glut of competition from HBO, Apple, Walt Disney, Amazon, Comcast, Viacom, and others, based on figures from data intelligence platform SimilarWeb in December 21. SimilarWeb noted that fewer consumers were cancelling Netflix based on a decline in cancellation rates. Netflix vice grip on the market has indeed slipped over the past 2 years as competition has escalated. According to one research firm, from the second quarter of 2020 to the fourth quarter of 21, Apple TV Plus, Disney Plus and HBO Max combined grew from 10.6% to 20.6% of global interest among consumers, while Netflix dropped from 55% to 45.4%. Now back to the markets. Energy stocks were pressurized by falling oil prices amid data showing that US weekly crude supplies unexpectedly rose. And on the economic front, weekly jobless claims increased, though economists downplayed the upside surprise, citing the impact of the Omicron virus. Initial jobless claims rose 55,000 to 286,000 in the week ending January the 15th, a 3-month high, confounding expectations for a decline to 225,000. It is likely that business disruptions due to the spread of the Omicron variant of COVID had an impact on the data this week. We suspect that these disruptions will prove to be short-lived, but they will create some volatility in the next couple of weeks, Jeffrey said in the note. And in other news, shares of Peloton Interactive were crunched on Thursday after a report indicated that the company temporarily planned to halt production of its connected exercise equipment to help curb costs in a period of slowing demand. Peloton stock was off nearly 19% in Thursday afternoon's trading and hovered below the company's initial public offering price for the first time since April 2020. The shares were halted 4 times during the session following the report from CNBC, which said that Peloton was cutting its forecasts for demand and pausing production of several products. The company made its public debut on the NASDAQ at $29 a share back in September 2019, before the coronavirus crisis took hold in earnest. The shares closed as high as $167.42 on January the 13th, 2021, but they recently changed hands at $25.81 in Thursday's session. The maker of home exercise products was a big winner early in the pandemic as people increasingly turned to its bikes and treadmills for pandemic-safe workouts that could offer a similar vibe to live, in-person exercise classes. But The company miscalculated demand as the economy reopened and slashed its forecast during its most recent earnings report. It is clear that we underestimated the reopening impact on our company and the overall industry, Chief Financial Officer Jill Woodworth said on the company's last earnings call in early November. The CNBC report noted that Peloton intended to halt production of its regular exercise bike for 2 months after the company already halted manufacture of its most expensive bike Plus model in December. The company also plans to curb production of its treadmill for 6 weeks, per the report, which added that Peloton doesn't expect that it will produce any Tread Plus products during the 2022 fiscal year. Business Insider reported earlier this week that Peloton planned to make substantial layoffs within its sales and marketing teams, and CNBC also reported that the company was working with consultants from McKinsey to evaluate the company's expenses and to consider potential job cuts. The reports came as Peloton executives recently said the company would add $250 and $350 in delivery and setup costs to its original bike and tread, respectively. Peloton pegged the price increases to supply chain costs. While the sales of fancy exercise equipment are a key part of Peloton's business model, the company also sells a membership that gives existing Peloton owners access to workouts and classes. The company has a separate membership offering for those who don't use Peloton equipment. Peloton stock has now lost more than 70% over the past 3 months, and it's plunged 84% since closing at its post-pandemic peak. The company is set to report its quarterly results on February the 8th. And the stock market's violent late-day reversal on Thursday signals more selling ahead as investors worry about a hawkish Federal Reserve and the earnings season. Thursday's reversal was especially wild, with the Dow Jones Industrial Average travelling more than 800 points between its high and low. The Dow ended the day off 313 points at 34,715. Again, its rallies are to be sold, Bleakley Advisory Group Chief Investor Officer Peter Bovar said. Just technically, the S&P looks like it will test the 200-day moving average. Today, it busted through the 100-day at 4,576. The 200-day moving average is a widely followed metric representing the average level at which an index or stock closes over 200 sessions, and that is 4,427. The moving averages are popular levels to trade around and often act as support. Bookvar said investors are nervous about the Fed's upcoming meeting next week, where the central bank could give more clues about how much and when it expects to start raising interest rates. Fed officials have forecast 3 interest rate hikes for this year and are ending their bond purchases or quantitative easing in March. That's a lot sooner than expected. The futures market traders are expecting an even more hawkish Fed, with 4 or more quarter-point hikes priced in for this year starting in March. The end of QE itself in March is an event in and of itself, and the market was way too nonchalant with that. History shows that QE is good for the market when they're doing it and not good for the market when they're not doing it, Bookvar said. The Fed has been winding down its $120 billion a month in bond purchases and was initially expected to end in June. Bookvar says the violent trading shows how nervous investors are becoming about tighter monetary policy. We broke up 65 or 70 S&P points before the sell-off, he said. You start thinking about that and it freaks everyone out. Evercore ISL's Julian Emanuel said there were clear signals during the market reversal that the selling is not over. Given the level of uncertainty surrounding the Fed, I wouldn't want to say that it would be the extent of it, said Emanuel, Evercore Chief Equity, Derivatives and Quantitative Strategist. You have to see how the combination of the FANG earnings and the Fed plays out. That's not likely to make things any more certain. Emanuel says he's become convinced that the S&P 500 is heading to its 200-day moving average after the NASDAQ 100 broke through its 200-day at 15,000. The NASDAQ 100 ended the day down 1.3% at 14,846. We would absolutely expect buying to come in at the 200-day moving average in the S&P 500, and we're open to that being a medium-term bottom, but there's no evidence yet that it will be a medium-term bottom in the S&P, he said, adding that investors need to show more fear. We'd rather see the VIX spike to the mid to high 30s before we thought an attractive entry point had been reached. The volatility index of the S&P 500, known as the fear gauge, ended up 7.3% to 25.59. The key is when you get to these moving averages, the intestinal fortitude of the holders gets tested. You know when you're in a decent market, when those key levels hold, and you know you're in a change market when you start to slice through them, said Bookvar. Scott Redler, Chief Strategic Officer of T3Live.com, said the S&P 500's breakthrough down the 4,500 signals more downside ahead. He's targeted 4,320 as a low, expecting the S&P 500 to lose about 10% in total and the NASDAQ to fall another 5 to 6%. The trend of the market gaping up in the last two sessions and then falling at the end of the day is adding to the bearish signals the market has already shown. He said that prolonged the inevitable, which feels like a lot lower prices. And on that front, Jeremy Grantham, the famed investor who for decades has been calling market bubbles, said the historic collapse in stocks he predicted a year ago is underway, and even intervention by the Federal Reserve can't prevent an eventual plunge of almost 50%. In a note posted on Thursday, Grantham, the co-founder of Boston Asset Management GMO, described US stocks as being in a super bubble, only the fourth of the past century, and just as they did in the crash in 1929, the dot-com bust of 2000 and the financial crisis of 2008, he's certain this bubble will burst, sending indices back to statistical norms and possibly further. That, he says, involves the S&P 500 dropping some 45% from Wednesday's close and 48% from its January 4th peak to a level of 2,500. And the NASDAQ composite, already down 8.3% this month, may sustain an even bigger correction. I wasn't quite as certain about this bubble a year ago as I had been about the tech bubble of 2000, or as I'd been in Japan, or as I'd been in the housing bubble of 2007, Grantham said in a recent Bloomberg interview. I felt highly likely, but I perhaps was not as certain. Today, I feel is just about nearly certain. In Grantham's analysis, the evidence is abundant. The first sign of trouble he points to came last February when dozens of the most speculative stocks began falling. One proxy, Cathie Wood's ARK Innovation ETF, has since tumbled by 52%. Next, the Russell 2000, an index of mid-cap equities that typically outperforms in a bull market, trailed the S&P 500 in 2021. And finally, there was what Grantham calls the kind of crazy investor behavior indicative of a late-stage bubble. Meme stocks, a buying frenzy in electric vehicle names, the rise of nonsensical cryptocurrencies such as Dogecoin, and multi-million-dollar prices for non-fungible tokens or NFTs. This checklist for a super bubble running through its phases is now complete, and the wild rumpus can begin at any time, Grantham wrote in his note. When pessimism returns to markets, we face the largest potential markdown of perceived wealth in US history. It could, he said, rival the impact of the dual collapse of Japanese stocks and real estate in the late 1980s. Not only are equities in a super bubble, according to Grantham, there's also a bubble in bonds, the broadest and most extreme bubble ever in global real estate, and an incipient bubble in commodity prices. Even without a full revision back to statistical trends, he calculates that losses to the US alone could reach $35 trillion. Grantham is a dyed-in-the-wool value manager who's been investing for 50 years and calling bubbles for almost as long. He knows his predictions are fodder for skeptics. One obvious question, how could the S&P 500 advance 26.9% in 2021, its seventh best performance in 50 years, if stocks were poised to plummet? Rather than disprove his thesis, though, Grantham says that the strength in blue-chip stocks at a time of weakness in speculative bets only reinforces it. This has been exactly how the great bubbles have broken, he said. In 1929, the flakes were down for the year before the market broke. They were down 30%. The year before, they'd been up 85%. They had crushed the market. Seeing the same pattern that played out in every past super bubble is what gives him so much confidence in predicting this one will implode similarly, and Grantham pins the blame for bubbles for the past 25 years, mostly of bad monetary policy. Ever since Alan Greenspan was Fed chairman, he argues the central bank had aided and abetted the formation of successive bubbles by first making money too cheap and then rushing to bail out markets when corrections followed. Now investors may no longer be able to count on that implied put. Inflation running at the fastest clip in 4 decades limits the Fed's ability to stimulate the economy by cutting rates or buying assets, Grantham said. They will try. They will have some effect, he said. There is some element of the put left. It's just heavily compromised. Under those conditions, the traditional 60-40 portfolio of stocks offset by bonds offers so little protection it's absolutely useless, Grantham says. He advises selling US equities in favour of stocks trading at cheaper valuations in Japan and emerging markets, owning resources for inflation protection, holding some gold and silver, and raising cash to deploy when prices are once again attractive. Everything has consequences, and the consequences this time may or may not include some intractable inflation, Grantham writes, but it has already definitely included the most dangerous breadth of asset overpricing in financial history. And that really sums it up pretty well. As I've been signalling over the last 2 or 3 weeks, we are definitely in a down cycle. The question, of course, is how far and how fast, and to what extent will that change central bank intervention and policy, or are they now out of ammo? We will see in the weeks ahead. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.